Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending June 12th, 2020. Just recapping last week, we had a pretty strong rally last week. Actually, I think it was one of the most impressive rallies that I've seen, one of the most impressive weeks anyway that I've seen since early back here when we first got a lot of short squeezes and everything. And the reason for that was that we saw small caps outperforming. We saw the economically sensitive cyclical sectors that really need economic growth to pick up to do well. The gains that were made weren't just the overnight session, like the first 2 weeks off this mid-May low, but they were in the cash session. They saw a good follow through. We saw global markets, European markets doing well. Now, there was some funky stuff. There was a lot of speculation. Valuations, like this is for Europe, valuations are at extreme highs, as you can see. So on this front, we're kind of in the upside down where you have 22 million unemployed Americans, but you see valuations stretching to levels not seen since the dot-com bubble or even further back. So it was a really strong week. And then we got that payrolls print on Friday, which initially from the headline looked really good, looked really strong. The market gapped up on it. But towards the end of the day, here's the NYSE. So like we saw the prices come off the day's highs. And then we saw bond yields, which had, for the first time in this entire rally, had confirmed this kind of pro-growth outlook that stocks have been pricing in. So here's the 30-year yield. It gapped up big. It was up like 15 basis points. So it was confirming that view. And then we start to get more information about that payrolls report where 4.9 million people that were unemployed were counted as employed. And as the day went on, we saw this change in character. You saw that with stock prices coming off their highs, and then we saw yields retrace a lot of that move. So there was a change in character. It was enough for me to open a new short in an area that I think had been really speculative, which was the retail sector. We'll get to that. But the overall point was that since this May low, where things really started to look dicey in a lot of places, that week over here was pretty much one of the strongest I've seen. So let's fast forward to this past week. And this is a weekly chart of the S&P 500. So here's the big strong week. The prior week here is this week. So the worst week for the S&P 500 for stocks since this crash. S&P lost 4.8%. The Dow lost 5.5%. And small caps, which had led this rally the prior week, lost the most, 7.9%, almost 8%. Here's a 60-minute chart of the Dow. And one of the things I've been pointing out was a broadening formation. So what I've been telling my subscribers, my members, is that this broadening formation, which is higher highs and lower lows, suggests that we're going to see an increasingly chaotic market with bigger swings to the upside, which we just saw off this May 15th or mid-May low, and bigger, sharper swings to the downside. This is a sign of a market losing its intelligent sponsorship and mostly being driven by speculation, by emotion, by rumors. And while the S&P had a real strong week this last week, notice this rising wedge. This is a bearish price pattern, has a bearish bias. We had one over here too. The general rule of thumb, and these aren't my favorite price patterns. I don't think they're as reliable as a lot of the other ones, but the general rule of thumb is when a wedge breaks, then it retraces its base, which we saw over here, and then a little bit some. One other thing to point out on SPY's daily chart here, we also saw an island top. Okay, so we have the gap here. This is the island above this trend line over here. If we look at volume, this big gap up that starts the island, pretty big, right? So that looks like an exhaustion gap. And then the break down here, this gap down, look at the volume on that. That looks like a runaway or a breakaway gap. And then what we do know is the island over here had a lot of speculative activity. So that is kind of a classic island top. One other thing I want to point out is the trend line right here where this island top occurs, where we gap up above and then gap down below and leave this island. This trend line is really interesting. Let me back it out for you. So it is right here above this big broadening top in the S&P 500. That's a really interesting place to have an island top in this bigger broadening top pattern. Here's a 30-minute chart of the NASDAQ 100. And again, another big rising wedge. We had a smaller one back here. Did not quite retrace the base, okay? Did find some support over here, but the S&P did. So we have this bigger broadening pattern. We did see some rotation this week from those cyclical sectors to the FANGs, or what would be considered like the secular growth, which is a slightly more defensive rotation, but in any case broke that trend as well. Here's a 30-minute chart of the Dow. Again, another little island top right here. And where did it break? right here at its broadening formation that's been going on since April over here. This is very similar, this run up above the broadening formation and break, as the 2-year broadening formation on the daily chart, which is to say this run up over here wasn't quite an island top, but the same thing breaks. So it's kind of like the micro, the macro. You see these price patterns play out over and over again in different assets on different time frames, and there's a simple reason. They've been around for hundreds of years. It's because they're moved by human psychology. Human psychology doesn't change. This price is, in part, a depiction of mass psychology, the crowd. Here's Dow Transports. They also ran above a broadening formation, and this longer term trend line where they kind of ran above just a little bit and then broke back below this week. Let me show you this longer term trend line, what it is. And this is a 5-day chart. This is the trend from the 2009 low. So we've seen this kind of same trend broken in other areas like IWM, NYSE. Here's the NYSE. Here's IWM small caps. We'll take a closer look at this area. Just a couple days from last week above that trend line and then breaks back down below this week. So really interesting where a lot of these breaks are occurring in terms of the bigger picture. And looking at the broadening formations, which we have on the main charts, like the 2-year broadening formation, and that we also have in this area over here, the kind of takeaway from that is what I've been saying is that we're going to get bigger moves up and then bigger moves down. So you can see a move up here, bigger move up here, much bigger move up here, down, bigger move down, bigger move down. So I expect that to play out as well on these shorter term broadening formations. On the weekly charts, the S&P 500 bearishly engulfed the entirety of last week, and that's the same for small caps. In fact, at one point on Friday, they had bearishly engulfed the prior 2 weeks. This sell-off this past week, well, here it is, mostly the cash session. So to me, it has more credibility because that's where you have volume, that's where the pros transact. So remember what I was saying too about last week's rally back over here, that it was impressive because it was led by small caps, it was led by economically sensitive growth cyclical stocks. So it wasn't just the market rallying on, oh, we have a V-shaped recovery, but people were putting their money where their mouth was. So what was interesting about this week, and it really started that Friday after the payrolls report, was that we started to see a rotation. And what this is a market neutral momentum style factor. So what I was saying last week was you saw this big dump of momentum. Now, that doesn't necessarily mean one sector, but most of the momentum stocks are typically like the mega caps, like the FANGs, Facebook, Apple, Amazon, Google, Microsoft, and then a lot of the defensive sectors like utilities or consumer staples. Now, conversely, the value or the cyclical sectors are kind of on the other end of that. So what had happened the prior week was there was this big rotation of dumping those momentum and heading towards the economically sensitive cyclical sectors, which are also called value because they've been beaten up the most, sold off the most on the way down. So this week, you can see that rotation was almost completely retraced. And this was one of the biggest rotations I've seen in years. We saw one in September too, and it failed real quick. This is another example of, the market moving towards this pro-growth outlook and then just abandoning it in a day, really. That's why the cyclical sectors underperformed a lot this week. That's why small caps got smoked this week relative to everything else. Here's another way to view it, and this is a 5-minute chart. In the candlesticks, we have the regional banks, and this white line is the 5-year, 30-year yield spread. The prior week, where we saw the cyclicals and small caps outperforming, that spread steepened a lot. So this is why I was saying last week looked more impressive than I've really seen since stocks rallied off that March low. But as I was saying on that last video on Friday, there were hints that it was starting to fade fast from 30-year yields, and you can see it in the curve here too. So early on this week, I told members, look, we have this curve completely reversing from steepening to flattening, and you'll probably see the banks affected first. This is the regional banks, and then after that, you'll see the cyclical sectors and small caps. So look what the regional banks did. They just followed that flattening yield curve down. So what this is really telling us was for a week, the market said, or the bond market at least, confirmed with the equity market and said, we see a reflation trade. We see the economy picking back up, the reopening trade, all that, which until this past week, bond market was not on board at all. But as of that Friday, right after payrolls, it started to change. And early this week, it just kept on changing. And you saw this real, just sudden reversal like you saw in the momentum factor. See the same thing in the yield curves, reflecting the same thing, going from an inflationary pro-growth to deflationary we have more trouble ahead kind of outlook. On the 30-year yield, this is what I said in the last video, that Friday right after payrolls went from being up 15 basis points to retracing with a shooting star. It looked like the start of a turn, just like we saw on the yield curve there in the last chart. Here's the 10-year yield, has been just kind of compressing in this range. So this is that kind of reflationary breakout the prior week and just retracing it all. So the point I'm trying to get at is that we had a real strong looking week the prior week, and that was completely reversed this week. So went from saying, we're starting to believe in this economic rebound to maybe not so fast. As far as sector performance on the week, S&P sector performance, it's not surprising given the signal that the bond market was giving. So the sectors that had done the best the previous week on this reflation trade did the worst this week, and those would be the cyclical sectors like materials, which I have here. It's 15-minute chart. Here is that run. You can see the trend completely broken. This is this week. Did find some support. Pay attention to these cyclical sectors. A lot of them came down to a support level on Thursday and Friday. Materials was down 8%. Here's the energy sector. Same thing. Here's the run. And here's the break this week. Also find some support, but down 11%. Here's the financial sector rallying off that mid-May low. Here is the trend break. Also find some support here. But again, one of the worst performing sectors, down 9.2%. The banks were worse. Regional banks briefly breaking above this trend on that reflationary idea and steepening curves. Breaks down back below it this week, down 11.5%. Now the sectors that were down the least were the ones that hold the mega caps. So it's weird to think of the mega caps like the FANG stocks as being defensive, but because they are secular growth rather than cyclical growth, they're considered more defensive than those cyclical sectors. So they were all down, but they were down the least, but they also almost all broke trends as well. Here's consumer discretionary, and this is a massive trend from the March lows, from the crash lows over here. So you can see that trend broken this week in that sector, and the retail sector is part of this sector. That's what I shorted last Friday. Here's the communication sector, solid trend. It is a rising wedge, but a solid trend. So this sector houses stocks like Facebook. So you see it's a mega cap, but again, broke that trend. And remember that these are the sectors that did the best, or let's say they were down the least. And here is the most influential sector, the technology sector. Here's that last rising wedge. So it just kind of barely broke that trend line. Here's a little bit closer look at it. I wouldn't call it definitive, but you can see a lot of these sectors came up to some sort of local support. And even though they're down less. So I think this sector lost 2% on the week versus energy down 11%. That's why you see the rotation in those style factors, like that momentum style factor I showed you. The prior week had been rotation away from those kind of stocks. This week was a rotation back towards them. So from cyclical growth back to secular or more defensive. Also, the defensive sectors held up better. So this is consumer staples. You can see it did pull back. It found support right over here at its 50-day moving average. This was a bull flag breakout, looked solid. The utility sector, same thing, breakout, did pull back. So again, they were down, but they were down much less than the cyclical sectors were. One of the ones I think had one of the hairiest charts, one of the hairiest breaks was healthcare, and it's the second most influential sector by weight behind technology. So here it is off the March lows. It's been consolidating in this big triangle, and it recently broke out of that triangle over here. So this is this past week. That is a complete failed breakout, and when you get failed breakouts, you very often get fast reversals. The bulls chase it. All of a sudden, they're at a big loss, and they try to get out on a little bounce like this, and you see a fast reversal down. So to me, this was one of the more ominous looking charts this week, even though it wasn't down the most. It was, kind of midway as far as sector performance, but it was a really ugly break and a failed breakout over here. Here's a 3C chart of the retail sector. This was the one that I shorted last Friday over here. One of the reasons was because it was one of these kind of cyclical sectors that had run up the most that prior week. I saw those changes in bonds suggesting that we might see that rotation fail, and it had a pretty divergent, negatively divergent 3C chart. So when I entered it here on Friday, I bought puts. I said my target for this is just a decline down to the 200-day moving average. Based on the 3C chart, I have no reason to take it off because it's still leading negatively divergent, so it's still a really ugly chart. but I wanted to make some money on this real quick. It was a 220% gain, and you can see it went from where I got it right down to that 200-day. So I took that off on Thursday, booked the profits, and maybe, I'll go back in on this one if it bounces up, gives me another opportunity, or maybe I'll do it somewhere else. But I want to take that gain and be able to use the profits for the next position I want to set up. As you can see, it did find some support here on Thursday and Friday at the 200-day moving average. That was another reason. And remember all those sectors I showed you, especially the cyclical ones that had all come down to some kind of range support. As far as the major averages, the S&P came down to its 200-day, closed a little bit below it on Thursday with a really ugly close at the low of the day. Okay, but it did hold above it on Friday. We saw some volatility selling Friday afternoon to make sure that it held above that into the weekend. The Dow just got above that 200-day the prior week, fell back below. It just sliced right through it. And I had told my members early in the week that I thought that was going to happen because the Dow transports, which tend to lead the industrials, had sliced before it the day before. So here's the Dow transports. They had sliced below here, and this is the next day when the Dow finally did it as well. But we can see some kind of support here with an inside day. So this was another reason, I want to take some profits on some of those shorts, but I left a lot of them still in place. Small caps, remember all those trend lines I showed you that are in this area, that major 9-10 year trend line, but just barely got above that 200-day and lost it this week. This is around the 100-day moving averages, somewhere right in this area, so kind of found some technical support there as well. Now, other than the bond market and yield curves giving some hints that there may be a turn, that last Friday and certainly early in this week, there were some other things too, like in volatility. So this is the market as of Friday the 5th. This is volatility's term structure. Typically when the market goes up like this, the S&P goes up, term structure steepens like this. So you can see as of like Thursday and Friday last week, the market was going up, but term structure was flattening. Okay, so this was showing some hedging activity. And let me just walk that forward to the rest of the week. So look what happens. It wasn't just a couple days, it was like the entire week. So this should not be happening. It should be doing the opposite, going down. And then when the market actually broke down on Thursday, term structure went into backwardation. So this is showing extreme fear. This hasn't happened since the market crash in March. This is the S&P 500, and this is VVIX, the volatility of VIX. So even a day earlier than term structure, it was moving up, showing incredible relative strength when it should have been moving down. Okay, so this big move, of course, is as the market's coming down, but showing some really odd relative strength as volatility's term structure was doing some odd things as well. And the same thing with VIX. So this is VIX in blue. Typically, it moves opposite the S&P like this. So as we were coming into this week, actually, what is that? Friday, Monday, Tuesday, Wednesday, showing unusual relative strength with the S&P moving higher. I've shown this to my members in some in-depth posts. When we get 10-day correlations like this, it marks a major turning point. When we get 30-day correlations, it marks like a bull market top. And we saw that actually occur in January of 2018, and we've had this big broadening top ever since. So again, the point is not just what the bond market was showing in that there was a change in tone as far as that cyclical trade, but also what volatility was showing, that people were picking up like hedges, more defensive activity than you'd expect to see. VIX made a monster move on the week. Notice it found support, adds 200-day moving average, monster move, 47% on the week, breaking above its 50-day moving average. Thursday over here was the 8th largest one-day move in volatility ever. So what I'm looking at here looks like a change in trend, a regime change in volatility. Here's VVIX. I thought we had one here in mid-May when the market started getting really dicey, and this is where we had that overnight ramp in the S&P for all of May, and we had one good strong week over here for the market. But VVIX, look at this move. I mean, this is well above that mid-May high, and the S&P 500 still about 7% above that mid-May low. So the way VIX and VVIX are positioned here, it looks like a regime change, expecting more volatility moving forward. And then finally, what maybe was one of the most interesting signals, this is S&P futures in the red and green candlesticks, and this is the dollar yen USD JPY in purple, was Monday. We started seeing safe haven currencies really moving, like the Swiss franc, the Japanese yen. So you can see it here on Monday, really diverging away from the S&P. And Monday was probably the most speculative activity I've seen all year. So I actually went ahead and shorted some more, got some more short exposure on this ramp up in speculative activity. And as you can see, dollar yen led the S&P lower. So here we come into the end of the week, have kind of like a little bit of a bounce, a little bit of a consolidation, which is what we expected, because Thursday was the most oversold day that I've seen really since the crash. Here's a little bit closer look. Here's Thursday. Here's the overnight session Friday. So I was expecting something like a flag consolidation, which is what we got, but we did see some ugly activity. The major averages hit new session lows on Friday. They did come back with volatility getting smashed in that last hour, but this was what I was expecting coming in to Friday, which is just to say a correction, a consolidation of this big loss. That's what we typically see. Plus, we had so many different support levels in play and a very oversold market. So pretty much what I expected to see, a little bit weaker here on Friday than I expected. And we're still kind of in a little bit of a weaker position. But a lot of times these consolidations can broaden out, become wider, and last longer. So heading into next week, my gut feeling is that we see a little bit more consolidation because we do have the support areas here, and we have major oversold as of Thursday. And oversold conditions can be worked off through correction like this or through time going sideways like that. And that's pretty much kind of like what a bear flag is. It kind of moves slightly up, but it's kind of more sideways drift. We do have these gaps right here, this island top. So if these gaps remain open, they don't get filled, that island top remains in place. That's a pretty ugly development. It's pretty ugly development as it sits. Remember, these rising wedges tend to retrace their base like what we saw over here. So if we do get a consolidation early next week, in the first part of next week, and Jerome Powell is testifying before Congress, so we may, then we can really dial in a downside target. So I did take some short exposure off, took profits on that XRT, the retail sector trade, like I said, but I left most of them in place because I feel there's a pretty high likelihood, a pretty high probability that we get a second leg down. Big sell-offs like this that are sharp, that have like impulsive breaks like this, typically come in two legs, and there's generally a little consolidation between. Matter of fact, I'll take you back to this one, and here's that first break of the rising wedge. It's really small, but that was a little teeny consolidation, a bear flag. I think it was intraday, and then we got a second leg lower. So that's kind of the norm. That doesn't mean that's as far as it will go. Sometimes this will just be the first leg. We'll get another consolidation and a whole another bigger leg down. I don't know at this point, but what I'm saying is that I'm leaning towards a consolidation in the first part of next week. And if so, then it might look something like this. And we can get a good opportunity to get some new exposure and also have a good opportunity to get a pretty accurate second leg down. But right now we do have some pretty serious support levels, whether it be the 200-day moving averages for some of the major indices or areas like this for some of the cyclical sectors. So we shall see, but this gap is really one of the important areas to keep an eye on, this island. Okay, I think I'm going to wrap it up here. Thanks for listening. Thanks for watching. If you enjoyed it, please give it a thumbs up. I appreciate that very much. And if you have questions or comments, as always, leave them in that section below, the comment section. Also, check me out on Twitter. You can follow me. I have a link below. Don't forget to check out the website. There's a link to that below, and you can check out subscribing, becoming a member, or you can sign up for the free posts. Everybody, have a fantastic weekend. I'll see you next week. Members, if anything comes up on Sunday night, I'll have a Sunday brief. Otherwise, I'll see you Monday morning. Take care, everybody.